ESG investing is a form of socially responsible investing that prioritizes financial returns alongside a company's impact on the environment, its stakeholders, and the planet. Welcome back to another episode of Quick Finance. We won't tell you what to do with your money, but we will equip you with the best information available to make your own smart choices and become financially free. Remember, an investment in knowledge always pays the best interest. Subscribe to the channel now, so you never miss any of our latest and greatest videos as soon as they're released. In this video, we're going to be taking a look at ESG investing. Let's get started. The financial performance of ESG stocks has recently drawn investor attention. During the market turbulence related to the COVID-19 pandemic, many companies with strong ESG track records showed lower volatility than their non-ESG counterparts. To many investors, that performance validated ESG investing and its premise that good corporate behavior means better business results. What does ESG stand for? ESG stands for environmental, social, and corporate governance. E is for environmental. The environmental component addresses how a company affects the planet through climate change policies, greenhouse gas emissions, carbon footprint and carbon intensity, water usage and conservation, overfishing and waste disposal, renewable energy usage, and disposal practices, green products, technologies, and infrastructure. Employee incentives promoting carpooling, public transportation, bicycle commuting, etc. S is for social. The social component of ESG covers issues affecting employees, customers, consumers, suppliers, and the local community. Examples include employee treatment and compensation, employee engagement and turnover, employee training and development, employee safety policies and sexual harassment prevention, diversity and inclusion in hiring, promotions, and pay increases, ethical supply chain sourcing, mission or higher purpose, customer service performance, consumer protection activity including lawsuits, recalls, and regulatory penalties, lobbying efforts and public stance on social justice issues. G is for governance. The governance component relates to board independence, leadership effectiveness, and business ethics. Specific topics include executive compensation, bonuses, and perks and whether they're tied to long-term business value. Policies that define and enforce ethical business practices. Diversity of the board and management team. Potential for conflicts of interest for board members. Shareholders' ability to nominate board candidates. Whether term lengths differ among board members. Separation of the chairman and CEO roles. How board votes are decided by a majority or by who receives the most votes. Whether the company issues dual or multiple class stock. Transparency of shareholder communications. History of shareholder lawsuits. How to evaluate corporate ESG performance. 1. Corporate reporting. Companies committed to ESG initiatives should be publishing measurable goals, plus the progress against those goals, in periodic sustainability reports. Some sustainability reports are better than others, however. Look for reporting that follows ESG standards established by the Global Reporting Initiative, GRI, and or the United Nations Principles for Responsible Investment, PRI. 2. Third-party sources. You can also use third-party sources to validate sustainability reports, such as MSCI ESG ratings, Sustainalytics ESG ratings. For employer-related issues specifically, see Fortune's Best Companies to Work For. ESG stocks reduce portfolio risk. In any industry, environmental, social, and governance issues pose serious risks to operations and profits. Below are 3 examples of negative outcomes that could have been mitigated with proactive ESG policies. Energy provider PG&E, NYSE, PCG, declared bankruptcy in 2019 due to climate change-induced wildfires in California. PG&E and its peers could have reduced their collective environmental risks by working proactively to limit the carbon emissions contributing to global warming. Tyson Foods, NYSE, TSN, was sued in 2020 for wrongful death after employees with COVID-19 symptoms were allegedly ordered to continue reporting for work. Wells Fargo, NYSE, WFC, fired 5,000 employees after the Consumer Financial Protection Bureau uncovered a fake account scheme in 2016. CEO John Stumpf was forced to resign, and the bank lost its accreditation from the Better Business Bureau. Companies actively working to address risks like these should see fewer business disruptions and produce more reliable financial results over time. That means lower downside risk for shareholders. High ESG focus, high returns. There's also growing research that, in addition to lower downside risk, ESG stocks generate comparable or superior financial results compared with their non-ESG focused peers. Asset management startup Arabesque found that S&P 500 Index 𝐥𝐤𝐤𝐿 companies in the top quintile for ESG outperformed those in the bottom quintile by more than 25% between 2014 and 2018. The stock prices of ESG companies were also less volatile. In the Journal of Applied Corporate Finance, Dan Hansen and Rohan Dhanuka concluded that there seems to be clear evidence that companies with high non-financial indicators of quality seem to perform significantly better on the market and accounting-based metrics. ESG as an indicator of strong leadership. Why ESG companies perform better isn't clear-cut. One theory is that a corporate ESG focus requires exemplary leadership. ESG initiatives are long-term programs, and a leadership team's ability to realize long-term outcomes while running the core business well is a competitive strength. Risks of ESG investing. 1. Lack of universal ESG standards. There are no agreed-upon standards for evaluating ESG performance. That creates inconsistencies in ESG portfolios and funds. You may be surprised to find some ESG funds hold tobacco stocks, for example. You want to be sure your ESG funds align with your values. Before investing in ESG ETFs and ESG mutual funds, learn how the fund screens its investments. 2. No long-term data on the financial performance of ESG companies. Longer-term data could show that ESG companies aren't as resilient as once thought. If that happened, investors who are wholly focused on financial returns would likely shift away from the ESG sector. 3. Companies could stop reporting on ESG issues. Companies could stop voluntarily reporting sustainability data. Any broad deprioritization of ESG attributes would reduce the supply of high-quality, investable ESG companies. Is ESG investing right for you? If you want to achieve strong financial returns while supporting companies with sustainable, future-oriented business practices, then ESG investing may be right for you. Remember, before you make any financial decision, you should always consult independent financial advice from a professional financial advisor. And with that, we've reached the end of this video all about ESG investing. Are any of you guys thinking about investing in some ESG stocks? Get involved and let us know in the comments section down below. If you enjoyed this episode and found it helpful and interesting, remember to leave a thumbs up before you leave. Also, subscribe to Quick Finance and click the notification bell so you're always up to date with our latest releases. As always, thanks for stopping by and watching. See you again soon in the next one.